Does the count on the works?
It's not going on.
Yeah.
We're good. Good afternoon, team from Comptabilite. On behalf of my team, myself, Paige, and Felix, we're here to just propose our solutions for you today. So in terms of today's agenda and mandate, just to go over briefly why we're here today, we are looking to analyze your current situation as well as prepare any relevant financial statements for the company. In terms of the actual agenda, we're just going to do a quick situational analysis just to get a better understanding of the scope of the company as well as the direction we want to go in. Look at the issues and recommendations in terms of the accounting measures, and then lastly, we're going to go into an implementation timeline as well as any next steps we need to take as the accountants and any next steps that you need to take as the client. So in terms of the situational analysis, just to give a brief current situation to make sure that we're all on the same page. In terms of the company history, you were founded last year, so 2019. You're an incorporated business. And in terms of your service, you design, you sell compost custom bins. In terms of the accounting framework, you are operating under IFRS. And in terms of the users for these financial statements, there is the bank. You do have an outstanding bank loan at the moment. Secondly, there is Arthur Messicotte, who is the owner. And then lastly, there is the government. In terms of the information from the government, we are just mentioning this as a user because it was mentioned with information from government papers. But in terms of that as a user, we did rank that as the least priority because from specific mention, there really is the bank and Arthur that we're going to place an emphasis on in terms of the financial statements. So just going briefly over our role, we are here to prepare relevant financial statements for the company. We're going to provide any recommendations as we see fit. And we also want to make sure that we can ensure the liquidity and the solvency for the company so that you can get future financing in the company because we are aware that you're looking to get a future bank loan. So just in terms of the SWOT analysis, very briefly, we do understand that as a company, we want to analyze your strengths, your weaknesses, your opportunities, your threats. In terms of the strengths, it was your first fiscal year. That being said, you did have relatively strong revenue streams, so we just want to say congrats. Good job. In terms of that, there is also high demand for custom compost bins, so it's a great market to be in right now. In terms of weaknesses, we did notice that there was relatively poor expense tracking, so this is something we would like to keep an eye on. And then secondly, just in terms of the complex financial reporting, given that you are such a small entity with 4 paid employees, Arthur, you're 5 employees total, we're not necessarily sure why IFRS was chosen versus ASPE, so we do want to go into that at the end. However, our entire presentation is based on the IFRS. So in terms of the opportunities, there was online sales. We know that you currently have a website, but you don't actually offer any sales online. Second of all, there is the increasing awareness of climate change, so that proactivity to actually start composting as a consumer. And there is the revenue streams growth. Currently, you have 4 revenue streams, so there is the potential to grow within those streams because subscription was currently the weakest. Lastly, in terms of threats, there is a threat of new entrants. Given your current situation, you are the only competitor, so we just want to keep the mindset that that's not always going to be the case. So we do want to incorporate that future planning to maintain that position. So just to go into the financial statements now, briefly, we want to really maintain a focus on the income statement as well as the balance sheet. So the key items that we've identified based on the information that you've given us prior to this meeting is the revenues, the expenses, the impairment loss from the wooden boards as inventory, your income tax expense, which will also lead to an income tax payable, how we deal with the website and the non-monetary asset exchange, how we deal with the life insurance expense, the accounts receivable from the subscriptions, as well as the bank loan, your PP&E, which would be your building, your land, and your equipment. So just to go into the actual revenues themselves, I'm just going to pass it over to Felix.
All right, so as you said before, you have fairly strong revenue stream. Right now, you haven't even been in business for a year, and yet you have revenues of over $100,000. So basically, you have 4 main revenue streams right now. The main one being the compost bins that you install at home. Then you have the subscription services, the compost worms, and the consignment in the stores, which is the kitchen bins. Basically, a quick overview of what the criteria are. Basically, you have to have performed the service. In a lot of cases, this is basically when you go to McDonald's, they give you your meal, this is performance. In your case, it's a bit more complex because you have to install, you have to construct the bin, and it's very customized. So what we decided to do for that is we decided a percentage of completion criteria. For this, we're going to see later what this is going to imply. We also saw that you have maintenance, which is also part of your performance. This is also going to influence the revenue criteria. Then it must be collectible. As we know, you collect the money beforehand, so there is no problem with that. And then it must be measurable. That is no problem either. So for the compost bins, the main one, we saw that you had sales of $129,000 this year. That being said, even though you received all the money, not everything is recognized yet. As I said before, the maintenance is not quite all done, and so you can't recognize the revenues for that service yet. We estimated the unperformed maintenance at about $13,000. And what we recommend is to recognize $116,000 for as revenues, and record the $13,000 as unearned revenues, which is a liability that's going to appear on your balance sheet. Now you also have bins in progress, which although you haven't quite delivered them yet, you can still record revenues because, as we said before, there is a percentage of completion that has been done. We've estimated with the percentages that you've given us that you have performed about $4,500 worth of these bins, and then there is another revenues of $8,100. Now, for the second revenue stream, the subscription services, although you have collected $4,800, since it's a 3-year service, we also did the percentage of completion, and so we just took the date and then we basically calculated what it would be up to that date. So although it seems like a pretty lucrative operation right now, the revenues is only $900. What this means is that to have a good idea of the revenues, you would have to perform a lot of those subscriptions. I'm not sure about what space this takes into your warehouse, but it really needs to be a high number of those subscriptions to have a revenue stream that's worth it. So we'd have to check into that. On the balance sheet, what this would mean is that you would have unearned revenues of $4,000, and we also saw that since people pay more if they go over the limit, you'd have an account receivable of $100, and yeah, that's it for the subscription. Now, for the other revenues, as we know, you have the compost worms, which is a very good complement to the bins that you sell. This is very straightforward. You have revenues of $2,700, and you give 10%, you give 9% back to the supplier, which means about $2,500 for the cost of goods sold. And then for the consignment, we decided to, we saw that it would be classified as a consignment because since you can go get them back at the clients, it is not part of their inventory, it's still part of yours. You still have rights over those, and so that means that it should still be part of your inventory, and it's not quite considered a sale at that moment. So what we saw is that you have revenues of $3,200, and what we really have to see the contract to be able to really assess whether it's really a consignment, because there wasn't enough information to see. So we really want to have a good example before going further into that subject. I'm going to hand back the clicker to my colleague Alexa, so she can talk a bit more about other financial issues.
So just to go briefly over land and building as to whether or not we want to capitalize or expense these expenditures. As for the capitalization, this is going to impact your balance sheet, so it's going to be reported as an asset. So in terms of our method, we did realize that the building and land were conducted as one basket purchase. So in terms of the fair value for the land and the building today, we looked at the percentage of what was allocated to each asset, multiplied that percentage by their fair value to get what they should actually be recorded at on the balance sheet. So that's around $188,000 for the building and around $63,000 for the land. However, there also were additions to the land and to the building throughout the year. So we did need to look into whether or not to capitalize or expense these. In terms of capitalization, what was added to the building that we could capitalize was the roof and the windows. So that adds about $105,000 to the actual work of the building. So your building's going to be around like $290,000 on the balance sheet. And then in terms of the land, there was a pavement adding. So because this was a land improvement, we could capitalize this. However, the landscaping that was done does have to be an expense, so that's going to impact your income statement. Next, going into some of the other financial statement aspects is going to be my colleague Paige.
So quickly to just look over the equipment. Equipment is another balance sheet item. So in terms of the capitalization, so there was a transaction that occurred between the business owner and the company. So the business owner bought the his saw that he had at home for $3,000, and basically now he looked on the internet and saw that there's a resale value of approximately $2,300, which is the current fair value of the asset. So therefore, when this is transferred to the company, on the company's balance sheet, this will have a cost of $2,300 as it is the current fair value. However, the fair value of the new saws is $6,400 total, so that is the cost of those, and they will be depreciated accordingly based on the useful lives that are remaining. In terms of expenses, so there are new blades that are required for these saws. However, this doesn't really include the asset. You're just maintaining it and ensuring that it's working efficiently. So this will be expensed for the $450, the $150 per blade or per saw. So now looking at the inventory. So the inventory, so there was a lot of raw materials that go into building this inventory. So one is specifically wood. So on the balance sheet currently, wood was capitalized, or would be capitalized at approximately $85,000 because you purchased the wood at $5 per meter. However, due to the market conditions, wood can only be resold now for $450 per meter. So this does mean that inventory, you must carry your inventory at either the lower of cost or net realizable value. So given the fact that you can't sell this inventory for the $5 for the cost of it, you do have to impair the inventory down to $450 per meter, which does result in an impairment loss of $8,500. This does flow to the income statement, and so now the inventory that is left over sitting on your balance sheet is $76,500. As well, there are other various materials that are still unused, but that go into the production process of $8,000, which is also sitting in the inventory account. So now looking towards income taxes. So as a corporation, you do have to pay income taxes. However, under IFRS, there is very specific measures of income tax expenses and income taxes payable. It is quite complicated. So basically, what must be determined is taxable income is different from tax expense because, again, tax is very, very cash-based, whereas accounting is much more accrual-based. So given this, there are going to be differences between an income tax expense and income tax payable. Given the difference in the nature of the differences, we can result in either a deferred tax asset or liability. So basically, we're going to need a bit more information to really come down to what that deferred tax asset or liability would be. However, a January 31st fiscal year is perfectly fine. The nature of your business as well. Compost, you might think that individuals might compost a bit more during the summer, but be a bit lazier in the winter, not want to go outside as often, so you might not be as busy. So January 31st year end is perfectly fine. So given that the income taxes are quite complicated under IFRS, it is potentially recommended to switch to ASPE, just because ASPE it is easier to track income taxes, and there is the income tax payable method, which basically your income tax expense equals your income tax payable. Much easier, less costly, less of a headache overall. And as well, just given the nature of your business, you're very small, you're starting out small, still private, ASPE might be a good direction to think about. Okay, so now to look at the website. So in order for an asset to kind of be classified as an asset, there has to be reasonable assurance that there's going to be future economic benefit, or probable, I should say, assurance that there's going to be economic future benefit. However, given that this website, you're just posting photos on it and there's no really sales that are going to be coming from it, it's very difficult to measure sales that could potentially result from having these photos up. Therefore, we can't classify it as an asset, and so it does have to be expensed. which does lead, we have to use the fair value because it was a bit of a related party transaction. Your friend built this website for you, so we have to be very conservative and use the reliable measurement that is given in the market, which is the fair value of $2,975 as an expense. It is important to note, though, that going forward, if you do decide to grow your company even more and potentially incorporate online sales, there would have to be a reassessment of the probability of that future economic benefit, but given that it's a potential revenue stream, most likely you'll be able to capitalize any costs that you incur to get your website up and running for online sales. So now kind of the key takeaways from what we've spoken about for all of these financial statement items. So what the bank is going to be interested in is that you do have a relatively strong revenue stream, and there is a lot of opportunity to grow. You do receive a lot of cash up front. So basically the bank will be interested more in your liquidity and your solvency and ensuring that you can pay back any kind of loan that they issue. As well for inventory, so one thing was that you did order a lot of inventory at once, which does pose a bit more of a risk just because you're going to have inventory on hand potentially for a bit longer, which does mean that there's a higher potential that it could become obsolete, as we saw that you're going to have to write it down. So it is maybe advisable not to incorporate a just-in-time inventory thing, but more of a don't hold as much inventory on hand, just keep less, use more of what you're going to need so that you don't have that risk of having to write it down. As well, given inventory, there's different ways to measure inventory. However, for the raw material of wood that we were speaking of, FIFO is the best method just because it's very easy to distinguish between the two, and most likely you use older wood than new wood. So now I'll pass it off to Alexis to finish up with the timeline.
So based on everything that we've gone through during this meeting, we do want to just outline what our timeline is as well as what your timeline is, just so that we can get these financial statements ready in time for the users. So in terms of our end, today we did have our planning session, so we are going to need a bit of information from you as a company. So based on that, the information that we do foresee needing is, is going to be what the company's current cash balance is at the moment. We do realize that because you collect so many fees up front that this is a very liquid and very big asset on your financial statement, specifically your balance sheet, and so we do want to get a better understanding of how high this number is, just so that we can better determine liquidity and solvency. Second of all, we're also going to want to obtain those consignment contracts. As Felix mentioned before, we really want to get a better look at that so that we can just make sure that we're classifying it properly for that. So in terms of this week, we would like to get that information from you on your end. We also would like to contact a tax specialist just to go further in depth for the income tax expense and payable if we do continue to pursue IFRS. Lastly, we also, once we have all of this information, we can then prepare the official draft financial statements. That said, within the month, we do plan on getting the final financial statements remitted to users. So on behalf of what we are going to need on your end, today, sometime this week, we are going to need to get that information just so that we can prepare the draft financial statements, get everything done and solidified. And upon having actually received the financial statements from us, on your end, you are going to be negotiating a new bank loan just to get that initial financing. And there is the potential that because it is a second bank loan, that there will be covenants just to protect that loan. So in terms of that, if there are any, there are going to have to be actions that are going to be planned to essentially get that security for the bank and to just make sure that the company has the most relevant financial statements once again, which is your key objective. So in terms of points to consider, covenants can result in more costly impairment of the financial statements. So this is something you want to consider if the bank loan does make sense, if you do go forward with this. Second of all, if we do want to make the switch to ASCII just because it's going to be less costly for fiscal year 2020 and moving forward. And then lastly, looking into ulterior sources of financing, we do know that a bank loan is of interest, but based on how much you are looking to get from the bank, it could make sense to potentially bring in a partner who has some business experience, who has something to bring to the table, who can offer that source of financing, because regardless of what financing you get, there will be some sort of loss of control, some sort of financial strain, some sort of pressure or covenants, and so bringing in another partner could release some of that stress while having that additional experience and financing and making it a win overall. Any questions? Thank you.
base your judgment about the criteria improving your asset? I mean, can you give me some example of improving your asset? Why, for example, the roof and the windows improving the asset instead compared to landscaping, for example?
So specifically, let's say for roof and windows, when we do install this to the building, it is going to increase the usefulness of the asset. So for example, the windows did have this capability because they have better insulation. It was going to decrease your heating costs throughout the year, which adds inherent value to the building itself. Within that too, the windows are actually have a useful life, so you do understand how much to depreciate it. Versus landscaping, you can't necessarily attribute how much value that's going to add to the land itself. And you don't know how long it's going to depreciate for. If you plant flowers, for example, can you safely say that that's going to add value to the land?
Okay, thank you. Can we talk about tax for a moment? You said there is some difference between the income statement and the financial report, for example. You spoke about difference. Can you give me some example based on the case, that difference we can observe between the
Yeah, of
income
course.
statement and the
So
balance sheet?
one type of difference is there are kind of more temporary and permanent differences. So a temporary difference, for example, could be depreciation versus CCA. So under Canadian tax laws, CCA, you basically are depreciating your asset much more quickly, and whereas depreciation, it's based on kind of like the useful life. And there are different methods to do it, so they're not the same. Therefore, these are differences that are just different in timing. So however, will kind of converge at a point in time at the end of the asset's useful life. But this is an example where potentially with CCA, you might have higher depreciation in the beginning, whereas under, say, straight line, it's constant throughout. So given this, these are differences between your taxable income and your income.
Yeah, good
Net,
example.
net income.
Can we talk about the life insurance?
The life insurance? So for the life insurance, basically, I mean, we view the life insurance as, I mean, you think of bigger businesses do pay out to their employees insurance and insurance premiums and things like this. Given the tax, we will have to look into it a bit further, but it might be considered, because it is given to a shareholder, potentially treated as like a deemed dividend or something. We will have to look further into it to get the specifics for you. Yeah.
And you spoke about the depreciation.
Yes.
Is there something, the depreciation is different, I mean, on the income statement than compared to balance sheet? Because of that, if we base on the IFRS,
Yes.
is there something we have to consider and add to the balance sheet?
Oh yes, there is, because your assets, your long-term assets are basically presented kind of net with depreciation. So when you do depreciation asset, you're accumulating that depreciation year over year, which does show up on the balance sheet. So you will have the kind of historical cost of your asset, which is what you paid for it, or the fair value of it at the time. And then you'll have the accumulated depreciation, which basically just kind of shows the usage of the asset, or of all the assets. And then you'll have kind of the net, which kind of shows the book value today.
Okay,
Is that kind of
good.
what you?
But I mean,
Okay.
the tax expense
Yes.
and the depreciation is different.
Yes.
If we base on the income statement than the balance sheet, do we have to add something else on the balance sheet for that reason?
The deferred tax asset or liability, is that?
I mean, the way we calculate tax on the expense of depreciation depends if we use the income statement method or the
balance sheet method?
Yes.
Yes, I believe under IFRS only one of them is allowed. I will have to double check to see which one, but I do know that only one is, they do get the same results in the end, however, only one is allowed to be used for IFRS. But again, yeah, they will get the same results in terms of the income tax expense, or, yeah,
Thank you.
yeah, no worries.
Yes, for the jobs not completed, did you base your answer on the hours spent or the cost?
I'm sorry, for the bids?
Yeah.
Oh, for the, well, you gave us, let's say it was 50% of the construction was done. We based ourselves out of that, and not quite the cost.
So 50%.
Yeah, and we also deducted Basically, what we did is we took that percentage and we also deducted the maintenance
Okay.
from the contract price
Okay.
to give us a better estimate. Because it is part of the performance, but it's not quite during the construction.
Ça fait 5 minutes.
Thank you.